Next keynote is Rick Kahlbaugh from Fortegra Financial. And actually, he's an entrepreneur as well. He started as a CEO serendipitously the day after Thanksgiving and met with a lady in the elevator, I think 70-something years old, and basically said, "What's wrong?" And it was a series of events, and he ended up being CEO. Then later, he went on to Volvo Insurance Company, and then ended up selling that. And then Fortegra called him up and said, "Hey, we want to hire you. You're very entrepreneurial. You're taking companies from small millions to billions." And now he's able to share with us his dream and his entrepreneurial journey. I'm very excited to announce Rick Kahlbaugh from Fortegra Financial, who's also a listed client of the New York Stock Exchange. Thank you. Thank you.
Well, he's right. I'm a lawyer, so I'm going to refer to notes here if you don't mind. So I'm going to give you my view. We're at a different point in our journey. We were a private company and are now public, listed on the New York Stock Exchange. When I was talking to these fellas at EO, I got an email from Scott Cutler. And Scott said, "We have this thing going on with entrepreneurs. As a listed company, would you be willing to help?" And he said a lot more than that. Scott is not one to be greatly efficient with words. And, you know, we're all the folks in this room, we're very busy. And I said, "We're in." That's all I said, is we're in. About 2 weeks later, I get a call and said, "Would you be willing to speak about our journey at Fortegra?" And so I'm going to share with you our journey, the lessons I learned, going from a private company to a private equity sponsored business and then on to a public company. The good, the bad, the ugly. I'll be happy to field questions. The only rule is there's generally nothing out of bounds. Just please remind yourselves that we are public now, so if you ask me, like, what's the quarter look like, probably won't be able to answer that one. So if you'll, I got to do this myself here. All right. I forgot about this, sorry. So the company, when I started in 2003, was a privately held company. We had 6 principal owners, and their net worth was trapped in those walls. In late 2002, they had a failed deal with AIG. Hank Greenberg tried to buy the business. But what that did is it spurned in those 6 aging investors a desire for liquidity. But they had a big problem. They didn't know how to execute a liquidity plan. They also had another problem, was they had very erratic revenue, very erratic kind of earnings. It was pretty much a classic, typically or family-run organization. The checkbook of the organization was the checkbook of the 5, 6 principal owners. Expenses were all over the place. And it was just a family-run, family-managed organization. So that was the business. When I got there, I saw a couple things. One is they were really good at processing massive amounts of transaction. They had a strong IT infrastructure. They had the platform to be much more than they were. So our dream, the management team's dream that came in 2003 was, 1, successfully complete the mission, create a liquidity event for our 6 shareholders. 2, position the company for long-term success. Be a place where people can start their career and end their careers, not just be a place where you come get a paycheck. And 3, someday be a public company. Those were kind of what we set out as the management team. Those were our objectives. But we had some hurdles to overcome. The company's formerly known as Life of the South. It was, as the name would suggest, kind of a sleepy little company located in Jacksonville, Florida. They had several insurance companies that they owned, but primarily did business just in Florida and Georgia. The biggest challenges we faced were, 1, cultural. We knew we had to make a cultural shift. And when did I realize that we had a big cultural problem? The first week. I was invited to a meeting with the chairman, the large investors, and of course the CEO came, the chief information officer, the chief marketing officer. Every chief of something was at this meeting. And it started at 11 a.m., and from 11 to 12 we talked about Georgia football. From 12 to 1 we ate. From 1 to 2 we talked about farming in South Georgia. From 2 to 3 we talked about politics in Georgia. And at 3:15 the chairman gets up and he's about to leave and he stops and he says, "Did we make any money this month?" And everybody in the room turns and looks at Ned Hamill, the CEO. Well, not one of the C executives knew whether we made a penny. There was one guy in this company that was accountable for every aspect of the operation, and that was poor old Ned Hamill. So at that point, I knew we had a significant cultural problem. We had a business that focused on activity, not results. And let me tell you something, that ain't a public company. Public companies, results matter, and they matter every day, every week, every month, every quarter, every year. But that's the hallmark of a great company. I don't need to tell you guys that. You're making payroll every month. You know results matter. I don't need to tell you that. But in this sleepy little organization, it really wasn't the hallmark of their culture. So I had a big problem of how I was going to make that cultural change. The business operational changes were fairly straightforward. We had to expand the geographic reach of the business, expand our product lines, develop a sales ecosystem, and we had to finance all that. But those were minor problems compared to the cultural problem. So you might wonder how we did. Now they told me that. There we go. So here's where I joined the company, 2003, right here. Here's give you some idea how we did. In 2003, the amount of premium processed by the platform was $150 million. In 2011, it was $1.9 billion. So we've had some success. From 2003 to 2007, we doubled earnings each year. We had significant revenue growth, we got our costs under control, and in 2007, we recapitalized the company with Summit Partners, probably the gold standard in private equity for mid-market companies. They are a fabulous private equity shop, and I'll talk a little bit about that. But after we recapped the company, we went on a binge of acquiring companies, and we are where we are today. We went public in December of 2010. Probably not the best year to go public, and certainly December of 2010 was not a good time to go public, but we decided that it was absolutely imperative that we go public for a number of reasons, not the least of which was the crisis of 2008, when I'm sure all of you had your banking relationships changed dramatically. And we felt like it was absolutely necessary for the development of the company to have access to multiple channels of capital, not just bank debt. So, against that backdrop, the algebra for success that we talked about in 2003, let's change the culture. We absolutely needed to change the way we did business, the way we managed our affairs as an organization. And let me just back up for a second. When I was in college, I was a college athlete. I played golf at a Division I school. And my sophomore year, I went to the NCAAs, and I got clobbered. I mean, I didn't make the cut. It was awful. I went there thinking, boy, I've really made it. I'm something here, and I just got whitewashed by the field. And on the flight home, my college golf coach, who was a 70-year-old man, said to me, in a very soft voice, he said, if you want to be a champion, you've got to begin to practice and play and prepare like a champion long before you're ever there. And I started to think, man, this guy's nuts. I practice every day. What the hell is he talking about? But it dawned on me a year later at the U.S. Amateur when I got whitewashed again that he was absolutely right. The competition that I was playing against prepared differently than I prepared, and they expected to win. I took this lesson and brought it to our business. I knew that in 2003 that we needed to begin to behave like a public company, plan like a public company, execute like a public company, operate like a public company, years before we were a public company. Years. Because that kind of change does not happen overnight. You can't build that infrastructure overnight. More importantly, you can't build that way of managing your affairs overnight. It has to happen over time. So, I really wanted to get our team focused on results. I needed to get our team focused on being accountable, and accountability had to start with me. It had to begin and end with me. And I knew that, so I was willing to take that on. We had to address the capital needs of the business. No doubt, you folks face this every day, and I'll talk a little bit about how we did that. And then a key element for your capital needs is a sustainable sales ecosystem. If you can't generate revenue growth, you can't attract capital. It's that simple. There's no magic bullets. That's all it is. And I've found that in each one of the business I've run. The cultural change I'd like to talk a little bit about. This was a pretty significant challenge for me. Personally, I was born and raised in Wilmington, Delaware. So I have a little bit of that middle Atlantic edge to me. I like a pace that moves very fast. Now I'm in southern Georgia, some people would say, northern Florida. I am the only Yankee in the business. And today they call me General Sherman. I'm not sure whether I should take that as a compliment or a negative sentiment. But we really did need to focus on changing the way we did business, how people perceived the company they worked for. But being a northerner in a southern atmosphere, I knew I faced significant challenges and I was going to get pushback because we still had all the same management. I hadn't changed people out yet. I really needed a catalyst. So if you're looking to change, my experience has been you need a catalyst for change. You need something that people can rally around, and I got it. I got it 3 weeks in. It was like a blessing from God. One of our largest investors who was providing subordinated debt to us said, we're out of the subordinated debt business. You got to pay $20 million in 1 year. And these guys had, oh my God, how are we going to raise $20 million? We're only making $2 million a year. How are we ever going to do this? And I said, well, I'm going to tell you how to do this. First things first, we've got to get our expenses under control. Secondly, we've got to start to grow this business and grow it consistently. But most importantly, we got to change the way we do business, the way we manage our affairs. They didn't have a business plan. Not a single business plan in the entire organization. So the first thing we did is we went about building business units and having a P&L and balance sheet for each and every one. Okay? Pretty simple stuff. But more importantly, every single month, the third Monday of every month, we met and we spent the time, effort, and energy to review their results relative to that plan. There's no magic. It's just making them accountable for what they're running, what they're spending, and what kind of sales effort that they were undertaking. But let me also point out to you that when you're trying to shift the culture, be very careful not to overuse your political capital. And I was guilty of this. I was the only one out there at the vanguard of the charge. And people got tired of hearing from me. They got tired of me beating them up all the time. And it dawned on me that what I really needed was a group of people who were like-minded, saw the same thing that I saw, and would be my apostles. And the cultural shift of the organization really began to gain momentum when I stopped talking. When I stopped talking about it, but my apostles took up the cause, and they started to talk about it, the change really began to accelerate. All of a sudden, people came to the meetings prepared. They came on time. And oh, by the way, about changing culture, you can do little things. I have an absolute rule, and it's probably draconian in some people's mind, but if we say we're going to start at 10, we start at 10. Not 10:05, not 10:10, not 10:15, not 10:01. So at 10 o'clock, I shut and locked the door. Now, the first time I did this, you would have thought that there was, I was just beheading people in the room. There were people knocking at the door, and after the meeting, this one senior guy came and said, "What the hell are you doing? Are you crazy? You embarrassed me in front of everybody else." I said, "No, you embarrassed yourself. You knew for 3 days the meeting was at 10 o'clock. You can't show up at 10 o'clock. That's disrespectful to your colleagues. Either show up on time or get the hell out." Now, in a Southern genteel environment, that's pretty tough talk. And now you know why they call me General Sherman. But remember, that's just talk. I mean, you are leading, you're talking about the cultural change, but don't forget the process. One of the most effective ways to engage people in the changing of a culture, in the metamorphosis of a culture, is to change the process. So we went from a business that had no plan to businesses that had plans. And we measured and monitored every activity. And it was amazing to see after a year or two how people started to carry around their plans. And they knew their plans backwards and forwards because they got asked. Without being asked, one group in particular posted their Big Five on their bulletin board. And every week they would talk about how they're doing relative to their Big Five or key measures. Big Five, Big Three, we didn't care. But they did that sua sponte, on their own, without being asked to do it by me. That's when I knew there was beginning to be this shift that we needed to be a bigger, stronger, more powerful organization. Last and not least, do not overlook the power of HR. Who's guilty of that? Me. I thought HR was a royal pain in the rear end. I'm a lawyer by training and education, so I don't necessarily like people telling me what to do or what I can't do. And then I have this entrepreneurial spirit, so I really don't like to be told what to do and what not to do. And I don't see why we can't do things that are logical. Well, HR rules are not always logical and well thought out and well fashioned. But a really good HR person can save you a lot of heartache, can save you a lot of problems, and they are the most magnificent apostles. And they can diffuse situations which will distract you for days and take your efforts and energy to move the culture of an organization. And they can set you back years or they can move you ahead years. So when you think about HR, do not make the mistake that I did, which is pain in the rear end, put them in a closet, just bring them out once a year to enroll people in benefits. That's a big mistake, and I made it, and I paid for it dearly. I would suggest that when you hire an HR person, you hire a seasoned professional who has had experience in bringing about change in an organization, and they will be your apostle that you look to. We have a great one in Melissa Cercelli. If you go online and you read our chairman's letter, my chairman's letter, she is specifically called out in there for the contribution she made to moving our company forward as an organization. And there's no greater testament to what she brought to our company. So I would encourage you not to make the mistake that I did. Look, you don't grow. We didn't grow without accessing capital. It is the lifeblood of an organization. So I'm going to just talk about how we did it, how I did it. I would say within the first month when I got to Life of the South, I began to assess our banking relationships. And this is very important because all of you are growing and developing. You have to anticipate where you're going to be. Most banks have a certain type of loan they like to make. They are comfortable with certain businesses. They're comfortable with certain business environments. Some are dirt lenders, some aren't dirt lenders, some are entrepreneurial and will put venture money out. But at some point in time, you are going to outgrow your bank's capabilities or their appetite. And you have to anticipate that long before your needs change dramatically. So our bank was Columbus Bank and Trust. Great bank, Synovus Bank. They had supported us since the late 70s. They were wonderful. There was no issue with them. But when we went to them and asked them for a $50 million line, silence. That wasn't something they could do. That wasn't something they even really had even a marginal appetite for. When we asked them for an accordion line, they participated in it, but they didn't really know how to lead it. So we began, long before we needed to change our banking relationships, talking to the Sun Trust, talking to the cities, talking to the Barclays Capital, talking to these banks for years. You have to lay that groundwork years in advance. You can't just show up and say, we'd like some money. It may work, it may not work. Most times when you're asking for a lot, it doesn't work out real well. My experience is take the time, go see these people, forge, as the leader of the EO talked about, forge these relationships because they are equally important in the capital markets as they are in the day-to-day sales activities. And remember, you are always selling your organization. Even at these preliminary meetings, lay out your plan. Tell them where you're going to go. Come back in half a year and show them how you're performing to your expectations. And keep doing it and doing it and doing it. Before we went public, just by way of illustration, I started meeting with Scott Cutler at the New York Stock Exchange in 2007 and talking about Fortegra going public. And, they were very preliminary, but they became more and more and more and more detailed. And they were remarkably helpful in the progress and during the process. And the same is true with our banking relationships. What I have found is laying that groundwork was terribly important to us having the capital facilities to grow, even in rough times in 2008 and 2009. I would tell you to educate yourselves on the capital markets. Now, what I mean by that is you're all in very specific businesses. You know your business. You know your customers. You know your innovations. You know your products. Do you know your peers? Do you know your public company peers? Do you know who covers them? What banks cover them? What do they have to say about the market that you're in? How do they leverage their business? How much cash flow do they have that supports their operations? What banking relationships do they have? Because that's some insight into what bankers like to lend into your industry. Those analyst reports, those annual reports, the proxy materials, learn about your peers, your public company comparables that will be magnificently helpful to you as you build and forge these relationships. I had to learn that the hard way. I really didn't understand that. But the more questions I got, the more I knew I didn't have enough information. I didn't have enough resources. I didn't know enough. I mean, I knew nothing. And I wasn't getting a hell of a lot of help from Summit Partners either. So I just undertook to learn all about our industry, our comps, how they valued those companies, what their balance sheets looked like, because I found that to be very useful in talking to the banks. I'd like to spend a few minutes talking about private equity. Many of you will consider private equity as a liquidity event. We had a private equity sponsor. They are now our largest shareholder. And I'm sure you've heard horror stories. So first, my assessment, friend or foe? Friend. A good private equity sponsor can bring to bear resources that you cannot possibly fathom. The skills, the number of companies they see, and their experiences can be unbelievably helpful to you as you build the company. But there is one critical component. If you're considering doing a PE deal and taking some chips off the table, as you may at some point in your careers, my advice to you is do your homework on that private equity shop. If they're making promises that seem very, very large and valuations that seem out of touch, let me tell you, they probably are. Just know somewhere you're getting gamed. Most importantly, when you're dealing with private equity, do your homework on their current sponsor companies and companies that they've disposed of. That's critically important because they'll tell you about their experience. Just some things to think about. Private equity. One, what's the hold period? All private equity sponsors have a different hold period. Some it's 3 years, some it's 4 years, some it's 5 years, some have evergreen funds, which means they'll hold forever if they need to be. On average, don't think that they're going to hold and participate with you more than 7 years. Generally, and why is that? That's because their funds have a limited duration. So when they come to talk to you, ask them this specific question. What fund are you investing out of if you're going to invest in my company? And when was the fund capitalized, and what's the duration of the fund? Because what you don't want to do is become a widow or orphan. And by that I mean if you get in too late in the fund, they're under massive pressure to flip that deal really quickly. Massive pressure. So they're going to put pressure on you to do things that may not be in the best interest of your organization, to get growth very quickly so that they can flip it and still satisfy the demands of their capital base. So really focus on that duration because that's the trick. Now look, they're going to use language that you're not used to. You're best to have really good lawyers who are experienced in private equity transactions, but the best way to know is to do your diligence on what kind of firm this is, what other parties' experiences have been, and have they been successful. I will tell you, if Summit Partners comes a calling, I'm all in. They do what they say they're going to do. They've met every single promise and every single commitment, but that's been my experience. I've talked to people who've had terrible experiences with them. We've been successful largely because we had a shared vision for the company. We both wanted the same thing. We both wanted to get this company public, increase its scale, and we both had a common interest in how we were going to do that. So that would be my advice to you on private equity and how to forge a good relationship there. This is one we're still working on. We don't have this right. I'll be the first one to say that. I think this is the most difficult thing that we have to overcome as a company. Sustainable growth, we've had great growth. Our compounding annual growth rate has been about 18% since 2003, top line and bottom line. So we've done okay. But largely, if you strip out the acquisitions, it's 6 to 8% organically. So we don't have this all figured out. So take what I say with a bit of grain of salt. You can probably teach me more than I'm going to teach you. So what I have found is product differentiation in our space is critical, both in services and product levels, because we don't want to sell price. And I'm sure you don't want to sell price either. So for us, we are constantly striving to deliver new product, innovations, and service that we can get paid for. That was really one of the most difficult challenges I had at the company. Because they were a small little company, they always thought, well, their sales tool was, we'll do whatever you want, just pay us a little bit of money. That's probably not the best sales model. So we had to change that a little bit. Upgrading the sales force, that's been a real challenge for us. If you have any insights into that, I'd love to hear them, because we find it very, very difficult in our business to find great salespeople, compensate them properly, and keep them within the team. What I've found is we look for young, hungry, aggressive guys and gals. I am gender neutral. If you can sell, we're going to compensate you. Very interesting. I think the guys from the New York Stock Exchange might find this interesting. In our company, I am not the highest paid person. Not even close. Not even close. The highest paid person in our company is a salesperson, and he makes 2x of what I make. But there's a hell of a big difference. He bets on himself every day. Every day. So we are trying to create a sales culture and organization because I believe that since I'm not betting on myself every day, if he wants to make $10 million, God bless. And I think if we're to grow as an organization, we absolutely have to be committed and resolved that those people in the C-suites, because we get paid regardless, need to allow the people who bet on themselves to make the most money. And if you're not prepared to do that, you're not going to have a sustainable sales organization. And that's just as simple as I can make it. I firmly believe that. Now, we'll see in 5 or 6 years whether I'm right. I could be the absolute biggest fool in the marketplace. But I believe that to attract great salespeople in today's marketplace, you have to give them that opportunity. If you don't forge that opportunity for them, there's no way. They may come, but they're not going to stay. And what we want at our organization is salespeople who come, stay their entire careers with us, because the switching cost is painful and expensive. The other thing that we have had to do, and it may be present in your business, may not, but remember, I talked about a culture of activity. I had to shift to a culture of wins. Now, that required us to do some things that were kind of painful. Our salespeople were paid salaries. We moved them to commission. Talk about painful. It doesn't get more painful than that. For several years, it was pretty choppy waters. But now they see their incomes going up and rising steadily. Much of that noise has calmed down now. But that's just something that you need to be prepared to do. So, we went public. Some would say foolish. I felt like it was the right decision, and I would say this in front of any other group. I'll say it again. I've said it before. It was my call, and I made the call, and I think it was the right call. December of 2010, the markets were very, very choppy, very unpredictable. We priced below the range, but we felt that, and I felt in particular, that the continued growth of our organization required access to multiple sources of capital. That I could no longer rely upon the banks to have the necessary appetite for debt to support the acquisition plans that we have to grow this business. So that's why we did. So for those of you who might be thinking about it, let me just share a few of our horror stories. Some good, some bad, some ugly, like I said. So the process basically starts with a bake-off. You've gone around and you talk to all these investment bankers and you invite them in, and they're all going to come in, and it is a beauty pageant. They're going to come in, they're going to tell you your company's the greatest company ever. We can take this thing out, we can get you this valuation, and they'll show you all these fancy graphs and all this stuff. Here's the bottom line. If you've been doing your homework all along and you kind of know what your peers are and your comps are, you'll know what the valuations are in the marketplace. So if there's a large public company trading at 10 times trailing earnings, well, guess what? You're not going to trade at 20. That's not going to happen. So they're going to tell you lots of stories. The most important thing is focus on valuation, and know this. You must pick a lead banker to be lead left. That's the guys running the show. When they're lead left, what they have to do is have success in 1, your industry. Know your space. 2, have a very, very good institutional sales force. And they have to have proven success leading IPOs in your space. You don't want anybody learning on your dime, because that's not a good plan. And believe me, I learned the hard way. We had folks lead left who were good bank, just brand new to our space. So it didn't work out real well. Accounting firms. I'm going to tell you a bit of a story here. We used a firm called Johnson & Lambert. We had used them for years. We had publicly audited financials for years. When we went through the bake-off, I asked one kind of critical question. Do we need to move from Johnson & Lambert to one of the big 4, Price Waterhouse or Ernst & Young or one of those other big shops? And uniformly, they all said no. Now, at the time, I thought, well, that's probably pretty good advice. What the hell do I know? Okay, we'll do that. So we hire PwC. We go through a re-audit, and we spend $1.5 million going through a re-audit. We are at the printers, which is you go through all the legal diligence, you produce all these documents, and they're ready to hit the button to send our registration statement to the SEC. And the guy, the lead partner from PwC, who now has $1.5 million of our dollars in his pocket, says, not so fast. We have a conflicts problem. We have not yet cleared, quotation marks, independence, close quotation marks, from the SEC. And I said, pardon me? We engaged you in March. It's now August. You've got to be kidding me. And he said, no, we'll get this worked out. We didn't get it worked out. So remember, I had fired Johnson & Lambert in April, hired PwC. I now take my hat in hand and walk across the street in Jacksonville and beg, because the SEC said PwC is not independent. They cannot pass upon your financials for purposes of your registration statement. I have to go back across the street, get Johnson & Lambert to sign up. We have to pay them $500,000. So now my audits cost $2 million. And they sign off on our financial statements. We get filed, and of course we went public. But the lesson to be learned here is I went on a roadshow. I was out for a week, 10 days, whatever the hell it was. I met with investors all over the country. Not one asked me who our accountants were. Not a one. So I paid $1.5 million for something that nobody cared about, simply so the bankers could check the box and be relieved of any of that question, who's that account? If they are PCAOB certified, they are fine. No institutional investor will ask, nor will they care. All they want to know is, do they have PCAOB certification, and are they certifying your financial statements? That's all they care about. There is no magic to the Big Four. So if they tell you that, it's utter nonsense. Please don't make the big mistake I made. Building a board of directors. I got some great advice from the chairman of Hershey. And he said, what you need to think about is your committees. When you're building a board of directors, don't think about anything other than committee chairs. You need a compensation committee chair who has experience. Say on pay is a big deal. They have to know how to kind of navigate those waters. Find an audit committee chair who has 404 credibility, but has also been an audit committee chair of a public company, because there are nuances to being that, and that experience will save you great heartache. Find a good governance chair. So when you're building the board, focus on the committees. That's the best advice I can give you. Find experienced people. If you choose to go down this path, which you may at some time, that's the best advice I can give you. It worked out terrifically for us. I would tell you, work with the exchange. They helped us find great directors. They gave us great resources to look to. They can be very helpful in this regard. The other thing is, you can call a public company CEO. Believe it or not, we do answer our phones. And if you call me, I will answer my phone, I will answer my emails, and I'll tell you what I think. And we're happy to help. Most of us are really, really happy to help you. Practical considerations. The roadshow is, there's just some funny things about the roadshow I want to point out, but I think you generally need to be about 75 million of EBITDA. Now, we were smaller than that, and I would tell you it was a bit of a mistake. And the reason is because of float. We don't trade a lot. We only trade about 30,000 shares a day, so our trading volume is not real great, and a 100-share trade can move our price. But generally speaking, I think, this is my opinion, and only my opinion, 75 million of EBITDA, I think you're good to go. That's a sufficient scale that you won't get caught in micro-cap hell, and we're kind of there, so, and working our way out of it. So I would tell you that that's generally the size you should be thinking about. Here's a really little secret that you don't know, and I didn't know. They discount your valuation to sell the stock. About 20%. That's the haircut you're going to take. So you've done all this work to build the company, and your blood, sweat, equity, tears, lots of anxiety, and the institutional investors say, oh, this is great, we love you, but I know you want 14, but I really am going to pay you 20% off 14, so here's your $11.80 or whatever that math works out to be. That's just the way it works. And you hope that that discount gets you oversubscribed, and then you get bounced and you get right back up to where you're supposed to be. Didn't quite work out that way for us. Coverage. Very, very important that you're not widowed. So everybody on your book, if you decide to go down this path, they damn well better be prepared to cover you, and that's analysts. And if you decide to go down this path, it's very important to spend a lot of time doing the IR work, because it will be on you. If you're leading the business, make no mistake about it, you are the IR professional. You may have them, we have two, but I spend probably 40% of my time meeting with investors and prospective investors. So if you're not prepared to spend that kind of time with those kind of folks, probably not the right thing for you. But it will be an incredible drain on your time. I'd like to talk for a minute about my sense of internal audit and SOX. The general perception in the world is SOX is a pain in the ass. Well, let me tell you it is. Let me confirm that belief. But it's not as bad as you would think. Here's what it basically comes down to. Every process in your business has to be documented, and if they're core or key control processes, people have to certify that they follow the processes. That's really what, I mean, it's a lot more than that, but that's really what it comes down to. I have found it to be a very, very good process for our company to go through. It was revealing to find out what we didn't follow and what we did. So it was healthy in some respects. Internal audit, I'll raise my hand right now. I didn't love them. Now I do. It took me about a year to realize internal audit was my get out of jail card free. They keep me out of jail. And if you have an internal audit function, probably not, but if you do, if you view them as your ally, it can be wildly helpful to you in how you manage your business. And we've had significant improvement in our overall control processes with our internal audit group. New York Stock Exchange. I have nothing but good things to say about them. We looked at NASDAQ, we looked at NYSE. Frankly, they're the gold standard. You know, I can't tell you how many people say, oh, you're an NYSE company, we'll do business with you. We're the same damn business we were before we went public. But the brand power of NYSE is, in my experience, very meaningful. So what didn't I expect when we decided to go public? What couldn't I have foreseen? I will tell you, if you're leading the business, you need to be available just as you are today, probably 24 hours a day, 7 days a week. 24 hours a day, 7 days a week. The other thing is, it will be amazing how many people in your business suddenly go to law school overnight. They will suddenly pass the bar exam. They will become experts in Sarbanes-Oxley compliance and SEC compliance. Be prepared to do those battles all day long about what SOX means, what SOX doesn't mean. It is interesting for the first year as you're getting everybody educated, because they have to sign lots of certifications that they think creates this large liability. That's not necessarily the case. But what I've found is there's a lot of internal education that's required. The other thing, just on a personal note, is you have a high profile today. But believe me, all of a sudden, everybody starts watching what you're doing. You no longer have any privacy. Let me give you an example. I was on a flight to New York to go to the New York Stock Exchange. And I have status on Delta, as many would imagine, because I have to connect through Atlanta to go anywhere. But for whatever reason, I couldn't get upgrade. I was sitting in my exit row seat, and the guy walks by, and he said, "You're Rick Kahlbaugh, aren't you?" And I said, "Yes, I am." He said, "Well, I'm an investor. Glad to see you riding in the back." I wasn't quite ready for that, okay? It is amazing how little things like that just creep up on you and you're not prepared for them. Another thing I wasn't prepared for is we all run businesses, and when we were private, somebody would say, how's business? I had a fellow ask me this morning, how's business? And I'd always say, well, it's pretty good, earnings should be up, blah, blah, whatever. And we go public, I can't say a word. I can't tell you how many times I've said, and I had to catch myself. And now it's, well, we're a public company, I can't speak about that. It can get me in trouble, it can get other people in trouble. And you don't want to be a big jerk, but you come off that way initially. So I would tell you that there's just a whole learning process that you go through when you go public that it will be interesting, or at least I've found it interesting. One thing they did ask me to, okay, that's too far. I'm missing one. All right. They asked me just to speak for 1 second about some thoughts on leadership, and then I'll take some questions. I want to leave you with one thing that I've found. Take it for what it's worth. Everybody in your organization does not have your vision. They may have your dream, but they don't have your vision and they don't have your skills. There's a reason you're doing what you're doing, is you have great skills, great vision, great leadership. But not everybody in the organization has the same horsepower that you have. Leading a business to success, what I found, I spend a lot of time connecting the dots, illuminating the path for the organization from the dream to how we're going to achieve it. And if you can illuminate that path, if you can connect the dots for them, I think you'll see your success rate accelerate. And I think that's what leadership is. It's connecting the dots for the organization. Anybody can build a business plan. Anybody can dream. But connecting the dots, showing the team how they're going to get from point A to point B and be successful, that's a leader. That's a leader. And I would also tell you, I have found, if you are willing to be vulnerable with your team, willing to admit your mistakes, willing to take accountability, they will as well. So with that, I'll be happy to field any questions. Yes, sir. How about if I hop down?
We've got some microphones as well.
I'll repeat your question. Sure. Yeah. That was a personal dream. So I'm sorry. What was the question? The question is, why did we want to be a public company? That was largely personal. I really wanted to lead a public company, and so that was all me. But more importantly, remember I said we wanted to perpetuate the company. We just didn't want to run it up with a private equity firm and then flip it and sell it. Because we have 500 people and a large, I'm sure like in your business, a large percentage of them, they're not well compensated. And they need their job. And so the way I looked at it is there are 500 spouses, 500 sets of children, all of who are counting on me to make the right decision here. And I want to see them be able to come, work their entire careers there, take care of their children, take care of their families. So there was a little more to it than just, I want to be a public company CEO and open the market. There was perpetuating the business, and we felt like that was the right environment. Yes, sir?
The original six, the goal initially for liquidity.
Yeah.
How did it turn out money-wise for them?
So the question was, the 6 guys that I talked about, they had a vision of liquidity. So let me set the stage for you. Hank Greenberg, I don't know the precise term, so I'm just going to be very general. I think he offered them $40 million. They got 3 times that. So if that helps you.
But a lot of that was the acquisition and the growth of the company, not necessarily just going public for liquidity's sake.
Well, remember, they were in 2003. The 6 shareholders got their liquidity in 2007, 3 years before we went public. When we went public, there were really 2 large shareholder bodies. There was the management and Summit Partners. And Summit Partners didn't take any money off the table during the IPO. We just raised capital and paid down debt. So for those 6 initial guys, they did okay. Now, I think a couple of them rolled over, but I don't know where they are today. Believe it or not, I don't follow the stock. I don't look at it every day because, like I said, 100 shares can move the price, so I don't pay much attention. Yes, ma'am.
Hi, thank you for speaking today.
Sure.
It was terrific. You mentioned to start acting like a public company early, and you talked a little bit about changes that you made to the board.
Mm-hmm.
Can you speak a little bit more about the timing of that? Obviously, you talked about focusing on the committee chairs, but how
Sure.
about the timing? How long did it take? And
Sure.
that
So
process?
let's just talk, I'll give you a little bit of a timeline. So in 2007, we reconstituted the entire board. And in 2007, we had 2 private equity, the 2 guys from the private equity firm. We reached out to the CEO of Everbank, and he joined our board, and we had the ex-CEO of a public company also join our board. So we started right away in 2007 with a recap of Summit. When we decided to go public, so I'm going to fast forward, 2009, we began our board search. Almost a year before we pulled the trigger. Because you have to, first, I didn't know about all this committee stuff, to tell you the truth, until 2009. And so I had to do a little research to understand what it was that we were looking for. And then what we did was we leveraged all of our investment banking relationships, asked them for names. We talked to the New York Stock Exchange and asked them for some suggestions, and they put us in touch with a group that had a large database. We chose not to go down the path of hiring Korn and Ferry or other headhunter recruiter. We looked for very specific people referred to us rather than getting the same old database of directors. We were looking for very specific skill sets, and so we told them what we wanted. We wanted an audit committee chair who was the former CFO of an insurance company, a public insurance company. I wanted a compensation committee chair who had been a compensation committee chair of a small cap, Russell 2000. So we have very specific ideas in mind of what we were looking for, and it takes a while to find them. And then when you find them, you got to interview them, and there's got to be a personality match, and they have to have the same philosophy about the board that I share. And my view of the board is they should be active. Not passive. That's just my view. That's the check and balance that our shareholders are bargaining for. So again, it takes a while. So,
Any surprise difficulties?
oh yeah. So the question was, any surprises in the process? Absolutely. We put, I will tell you this without naming names, but we put one guy on the board, and shortly after we put him on the board, his company was thrown into an SEC investigation. That was a big surprise. Now, we weren't public at the time, but we had to quickly take some action. And the other thing to remember is once they're on, they're really hard to get off. They're really hard to get off. So be very selective is what I would tell you. Sure.
Rick, thank you very much.
Sure, absolutely.
We're going to have to wrap up.